start our results service now on Power Lunch. On the roof with us is Bradley Doig, who is the Head of Business Development at Petmin. Their half-year numbers came out today, and a 16% fall in profit after tax was announced. Bradley, thanks very much for coming in. The first thing I have to say is that, the mining companies have had such a bad time over the last year or so, but in your case, when it rains, it pours, literally.
Yeah, we had a tough, we spent a lot of money developing our Somkhele mine. We've invested a lot of money in it recently, and we didn't get the throughput simply because we had an unprotected strike for 15 days, and we had 20 odd days of rain, consecutive rain, which made it very difficult to move the material. But overall, had we had the ability to move that material, about 190,000 tons, we would have been ahead of what we forecast for the 6-month period. So the business is in good shape. It was a function of time.
And it's about learning to mitigate against those risks now moving forward. Talk us through this new policy you have, a new stockpile policy to enable operations at Somkhele during these rainy periods.
Yeah. Normally what we do is we forecast for 12 days of rain consecutively, and we manage that in the budgeting process. What we've done, we had an exceptionally rainy season this season. So what we've done is we've actually now going to move, we're going to have 100,000 tons of run-of-mine stockpile at the top of the pits, and then we're going to have 30,000 tons of stock at all times at the plants. So to the extent we have this rain delay, we can actually continue to process, because processing is not affected by the rain, it's simply the mining process.
Sometimes we're guilty on Power Lunch of not looking at these smaller companies very much. So can we take one step back,
yes,
and you can explain exactly what Petmin's operations are?
Petmin is the largest producer of anthracite in South Africa. We have a mine, Somkhele mine in KwaZulu-Natal. It's 75 km from Richards Bay. We produce 1.2 million tons of anthracite products, and we produce 600,000 tons plus minus of an energy product. And that's really our business. We have 3 operating plants, and we have an export facility at Richards Bay for our export material. And that's essentially what it is. Our major customers are the Brazilian iron and steel producers and the local ferrochrome industry. So that's essentially our major operation. We've owned other businesses in South Africa, but part of our philosophy is, take things up the curve, make them profitable, and at some point they are disposed of if the prices are right. So we've done that in the past.
That's what you do. In what supply-demand scenario right now?
So supply demand, the pricing is soft, but the demand is there. So our local pricing remains fairly robust, but the export pricing, given the fact that it's more of a commodity and not a value and use product, and on the export side, it's a little bit softer, but the demand still is there. So we're comfortable with the sales profile.
But of course, what you've highlighted, in other words, a so-called act of God, in other words, a lot of rain which has hampered you somewhat. Plus, of course, the strikes means that you really need to be more diversified. And I know you're looking to do so. Tell us about what you've got in the pipeline.
We're in the pipeline. The project we're focusing particularly on is one in Canada. It's a very large iron sands deposit, but it's not really the iron sands. I mean, it's enormous. It's really the use of that iron sands. We're actually going to go into pig iron production in the United States, and we're a long way down the line in terms of understanding the economics of what we're trying to put together. The United States steel industry, we're growing at about 4% per annum now. We think there's a lot of value in playing in that market. We also see, from our perspective, we've looked at their demand for pig iron, which is key. We could be at the bottom end of the cost curve, we think, with this project, still applying into that market. And given the cheap electricity in the United States, which is obviously everyone's aware of that, we think we can take advantage of that.
How's that comparing to your situation here in South Africa? Because of course we've seen NASA approve 8% tariff increase for Eskom.
Yeah, fortunately our operations in South Africa are not electricity intensive, so we're not really impacted by that as much. In the US, we're seeing prices ranging between 4 and 5 cents a kilowatt hour for quite long periods of time that you can negotiate. So we're really excited about using that as the leverage for this project. And obviously there's other developmental opportunities. They're very keen to see this reindustrialization, I suppose, if you want to call it, going on in some parts of the United States. So we've got 9 sites that we're busy evaluating, and we'll pick one of them in the next sort of 3 to 6 months.
Share price was down 3.5% on the opening, and I'm always told never to speak to directors of companies about the share price. The market must determine what happens, but it has come down quite sharply in the last year or so, down from 320, 330, I think. So it's down about around a share. Shareholders happy?
Shareholders are happy. It's a function of, I think asset prices have also come off dramatically on a relative basis if you look at the mining sector. So, and I think, I don't know what our forward PE is, probably 12 or 13. So it's not inexpensive relatively. So I still think that there's, when we see the growth in Somkhele come through in the next financial year, I think the share price should move accordingly.
Take us through your JV strategy right now, because that part of your strategy moving forward in terms of reaping maximum cost efficiencies and productivity moving forward.
Two important things about the JV with our mining contract. And number one is to sort of homogenize the entire labour force. So we also invested 50% in the mining contracting company, and everybody's now paid on the same scale. So that should avoid disparities in terms of which may lead to industrial action. The second point is we're going to see the margins out of that business as well, because it's the biggest cost component of our entire business at Somkhele. So I think that risk mitigation process is definitely part of our thinking, and sharing risk as well. I think that's important.
Looking at the role of the junior miner, the smaller miner on the JSE Securities Exchange, it interests me strangely because in certain instances you get hit a lot harder than the bigger boys would by certain events like yours, because you don't have the diversification that, for example, Billiton would have. But on the other hand, you can take assets and be more nimble and get more out of them than the big ones would, because it's simply not core to their business. Is that a valid point for anyone who wants to have a look at a junior miner?
Absolutely. I think there's two things. It's obviously the experience of the management team that's quite critical, having been in the business. I mean, a lot of us have been in this business for a long time, so we understand a lot about the asset classes that we're invested in. But also you are able to move quickly, and I mean, in our case, management and our B partners have a significant stake in the company as well. So you effectively, while we respect other people's capital, it's also our own capital that we're investing. So it's very important for us, and we have done in the past. Our silica operation, we bought it, was unloved. We turned it around into quite a positive cash producing business. We sold it at a significant return of 40% plus per annum return over the period we owned it. So we do that, and we think that's the ideal space for sort of junior mining companies, to take things that are not right in the space of the big guys, but you need to be nimble and quick. And also capex. I mean, we've got to be sensitive to capex, because platinum space, for argument's sake, is huge capital intensity, whereas the things we are looking at are less capital intensive.
You've got cash though. You generated 161 million, didn't you?
Yeah, we generated 161, and that's indicative of the cash producing nature of Somkhele as an asset. And hopefully going forward we'll see the real benefits of that come through now with the money that we invested. There's a lot of money in that asset over the last 2 years, so hopefully to see that.
To what extent does that stand at risk though? Because you've highlighted in your report that production increased by 44%, yes, but your infrastructure and your staff levels were geared to 100%, which negatively impacted your profit margins, and of course you're having to deal with this fixed cost base now.
Yeah, no, it's a volume game for us. We have to get those volumes out of the pits. We have to feed those two plants. They're hungry, and we spent the money. So, and that was part of the issues around the rain delay and the strike, not being able to get that volume through the plant. Obviously negative impact on the unit cost basis. So that's really much of our focus is on that.
Never say never again, of course, but at least you've had two events that have been lumped into one period. You've come out relatively unscathed, and hopefully the next year will be more kind to you.
Yes, I certainly hope so. But and also to management to mitigate these risks as well the best we can.